Oil just hit $56.25 per barrel. U.S. forces just seized a Russian-flagged oil tanker in the North Atlantic, along with a second sanctioned tanker in the Caribbean. The United States has just seized control of Venezuela and 50 million barrels of crude. President Maduro is in custody. OPEC Plus is holding back $3.24 million barrels per day of oil supply. And the market's response to all of this drama? Well, prices keep falling. The geopolitical risk premium, the extra price traders pay when supply faces disruption, has vanished. Not because risk disappeared, but because the market has decided it simply doesn't care anymore. In the next 4 minutes, you'll discover why a military intervention in a country holding the world's largest oil reserves can't lift prices, where natural gas just crashed 43% in 3 weeks despite record export demand, and what the power industry is spending $212.1 billion in 2026 actually means for the fuels that matter. I'm Mark Roach, petroleum engineer and deal maker. Some people call me an oil man. I have 30 years in this business, and this is FutureWise Energy, an independent analysis of what the market is actually pricing versus what the headlines are selling. Baker Hughes reported 546 total rigs for the week ending January 2nd. That's 412 oil rigs and 125 gas rigs, down 43 rigs year over year. U.S. crude production, well, it's still remaining almost 13.9 or 8 million barrels per day. Just 26,000 barrels per day below the all-time high set about 3 weeks ago. The efficiency gains, well, they're real today. They're not the story today, but the story, what's happened over the weekend on January 6th, President Trump announced that Venezuela will relinquish 30 to 50 million barrels of crude to the U.S. That's worth approximately $2.8 billion at current prices. This followed a U.S. military operation that resulted in the capture of Venezuelan President Nicolas Maduro. Energy Secretary Chris Wright stated the Trump administration plans to control Venezuelan oil sales indefinitely and use the proceeds to rebuild Venezuela's economy. Well, the White House has scheduled a meeting for Friday, January 10th with executives from ExxonMobil, Chevron, and ConocoPhillips to discuss Venezuelan oil sector. Chevron has reportedly lined up 11 ships to sail to Venezuela to export the country's oil. Venezuela holds 303 billion barrels of proven reserves. That's more than Saudi Arabia. But the country produces only about 1 million barrels per day. That's down from 3 million barrels a day back in the 90s when I was there. And that's due to years of technical decay and sanctions. Previously, Venezuela exported primarily to China and Russia. China covered approximately 4 to 5% of its oil imports from Venezuelan supplies. Analysts now suggest Venezuela crude exports could be meaningfully redirected away from China toward U.S. Gulf Coast refineries. So let's be clear about what just happened. The United States effectively took operational control of a country with the world's largest proven oil reserves, and that's a supply source that could theoretically add several 100,000 barrels per day relatively quickly, and potentially much more over time with proper investment. In any other market cycle, that would be a headline of risk. Traders would panic because about where those barrels would flow. Prices would spike on uncertainty, but WTI, it dropped. Brent crude sits at $60.12, down 21% year over year. Morgan Stanley, Goldman Sachs, and the EIA are all forecasting oil in the $50 to $55 range through mid-2026. The reason is simple. The market is facing a structural oversupply expected to average 2 million barrels per day through 2026. Global petroleum inventories built sharply in the second half of 2025 at rates approaching 2 million barrels per day. OPEC Plus confirmed on January 4th it will maintain current production levels through March of 2026, holding approximately 3.24 million barrels per day of output cuts in place. That's 1.24 million barrels per day of voluntary cuts, plus 2 million barrels per day of baseline cuts implemented since 2022. But even with that discipline, non-OPEC supply keeps growing. U.S. production's near record highs. Brazil, Guyana, Canada, Argentina are all adding barrels. OPEC Plus has shifted from dictating market terms to managing a slow erosion of its influence. The geopolitical risk premium is gone because spare capacity and efficiency gains have made single supply disruption irrelevant. Russian oligarch Oleg Deripaska warned that if the U.S. controls Venezuelan oil fields, they will control more than half of the world's oil reserves and could drive prices below $50 per barrel. That matters for Russian budget planning, which pencils at higher price assumptions, meaning that's what they're planning on, higher prices to meet their country's needs internally. It also creates leverage over China, which loses access to discounted Venezuelan heavy crude. Now flip to natural gas, because the picture there tells you something entirely different about market structure. Henry Hub natural gas sits at $3.52 per million British thermal units, BTUs, as of today, January 7th. That sounds reasonable until you realize it collapsed from December highs near $5. Physical spot prices crashed even harder. Henry Hub spot traded as low as $2.86 per million BTU on January 6th, yesterday. That's a 43% decline from December's monthly average of $4.13. What's the cause? Unseasonably warm weather forecasts are decimating heating demand across the United States. Natural gas inventories are rebuilding rapidly, but here's the tension underneath the price action. The EIA projects Henry Hub averaging $4 per million BTU in 2026. That's up 16% from 2025 levels. Why? LNG exports. The U.S. is now exporting approximately 14.9 billion cubic feet per day of LNG, liquefied natural gas, in 2025, last year, and they're expected or projected to grow 10% to 16.3 billion cubic feet per day in 2026. Well, that's a 25% year-over-year growth driven by new export terminals coming online. Vistra Corp just finalized a $4 billion acquisition of the Cogentrix Energy natural gas generation portfolio, adding 5,500 megawatts of gas-fired capacity. That deal reflects something structural. U.S. electricity demand, well, it's surging. The EIA projects a total electricity consumption reaching 4,199 billion kilowatt hours in 2025. They have to make these estimates. That's for last year. And they're estimating 4,267 billion kilowatt hours in 2026. Now, both of those look to be record highs. And the data driver? I mean, you know the answer: data centers, artificial intelligence infrastructure. The industrial electricity demand is growing 2% in 2025 and 3% in 2026 as semiconductor and battery manufacturing operations are also coming online. Commercial sector demand is rising 2% in both years, driven by data center power consumption. U.S. power utilities are projected to spend a record $212.1 billion in capital expenditures this year in 2026. And that's a 22.3% year-over-year increase. They're racing to secure new electricity supply for data centers whose power demand is outrunning forecast. Now, natural gas faces conflicting pressures. LNG, liquid natural gas, that export growth and power sector demand are providing structural support. But near-term weather-driven demand swings and expanding solar capacity is creating turbulence, or meaning that they're pushing the price down some. The EIA forecasts domestic natural gas generation will fall 4% in 2025 as higher fuel cost and solar capacity displace gas-fired power, even as total electricity demand grows. So gas becomes a balancing fuel, squeezed between renewables displacing it during favorable conditions and data centers requiring it as a reliable baseload when wind and solar can't deliver. On the corporate side, consolidation continues. On the corporate side, consolidation continues. SM Energy is acquiring Civitas Resources. It's a $13 billion merger focused on Permian Basin assets. Occidental Petroleum completed the sale of its OxyChem chemical business on January 2nd to strengthen its balance sheet and refocus on oil and gas. Azure Holding Group, well, it announced its 10th Permian Basin operator acquisition in 2025. Those aren't empire-building moves, but they're survival positioning. Global upstream deal value dropped about a third in the first half of 2025 to roughly $80 billion. The mega Permian consolidations that defined 2023 and to 2024 are mostly done. What remains are mid-caps buying scale and cost synergies in lower price environments today. Technology continues advancing. ExxonMobil's Coke proppant play is delivering 15 to 20% first-year production uplifts across 200-plus Permian wells, translating to roughly 42,000 barrels per day of incremental output. That cost advantage compounds when you're producing petroleum coke at $20 per ton, while independents pay $500 to $1,000 per ton for ceramic proppants. Chevron's 20,000 PSI blowout preventers are unlocking ultra-high pressure reservoirs in the Gulf of Mexico, with break-even cost running $20 to $35 per barrel. AI-powered anomaly detection, digital twin technology, and industrial low-T sensors are reshaping operations and driving efficiency gains across the industry. But none of that technology protects you from what sanctions, weather, grid failure, or policy shifts can add or remove. More effectively supply than supply in a week than most technology programs will offset in a year. Standard Chartered predicts U.S. oil production will peak at 14.34 million barrels per day in March 2024 before declining. The EIA projects 13.37 million barrels per day in 2026 from 13.42 million in 2025, the first annual decline since 2021. Efficiency gains and longer laterals are stretching the timeline, but the Permian is approaching maturity. The law of diminishing returns, well, it's real. Heading into 2026, oil faces downward structural headwinds from oversupply and weak demand. Gas has firmer support from LNG and power demand, but that support rests on permitting, trade policy, grid design. That can shift overnight. Now, Venezuela is back in play, but production recovery requires $100 to $250 billion invested over a decade, plus years of institutional rebuilding. The technical expertise that left when foreign operators were expelled doesn't return when you show up with a policy announcement. You own the reserves legally, but ownership means nothing without operational capacity. The market's message is clear. Geopolitical drama doesn't override fundamentals anymore. When you're staring at 2 million barrels per day of surplus, even seizing control of the world's largest oil reserves can't move the price. The invisible hand isn't ignoring the news. It's telling you oversupply, or that supply overwhelms every other variable right now. And that won't last forever, but it will last longer than most expect. The cycle will turn when depletion, underinvestment, or genuine supply disruption finally exceeds the efficiency gains holding production aloft. Until then, the markets reward operational discipline, balance sheet strength, not headlines. Position accordingly and remain the most expensive barrel is, position accordingly. And remember, the most expensive barrel is always the one you assumed would never matter. I'm Mark Roach, and this is FutureWise Energy.